If you have a bank account in the US, this video is about you. Most Americans believe financial power lives on Wall Street. That belief is about to be tested. Because over the past 3 years, the Chinese yuan's share of global trade settlements has jumped from 2% to nearly 5%. That might sound small until you realize it represents over $3 trillion shifting away from the dollar system. The next major financial shock may not arrive in a decade. It could arrive within the next 12 months. And when it does, you won't hear it first from politicians. You'll feel it when your money buys less, quietly, instantly. Your grocery bill will tell you. Your gas pump will tell you. Your savings account will scream it. If you want to understand global money shifts before they hit your savings, hit subscribe. And comment below, do you think the US is ready for what's coming? People think China's challenge to the US is about trade wars, tariffs, or factories. But those are surface-level battles. The real battlefield is banking. Because whoever controls the flow of money controls the rules of the global economy. Think about it. Trade disputes make headlines. Tariff announcements move markets for a day. But banking infrastructure? That's the invisible architecture that determines who has power for decades. And right now, that architecture is being quietly rebuilt, without American oversight, without dollar dependency, and without most people even noticing. For nearly 80 years, the US dollar has been the backbone of global finance. When countries trade oil, they settle in dollars. When governments borrow internationally, they borrow in dollars. When central banks build reserves, they hold dollars. The numbers tell the story. 88% of all foreign exchange transactions involve the dollar. 59% of global central bank reserves are held in dollars. Nearly 60% of international debt is denominated in dollars. This isn't just currency, it's control. When the world needs dollars to function, the US Federal Reserve becomes the central bank for the planet. American banks become the gatekeepers of global commerce. US financial regulations become everyone's problem. But here's what's changing, and this is where the data gets disturbing. China has systematically expanded its state-owned banks across every continent. The Industrial and Commercial Bank of China now operates in over 50 countries. Bank of China has branches in 61 countries. These aren't small offices, they're full-service institutions processing transactions that never touch American soil. Between 2013 and 2024, China's Belt and Road Initiative financed over $1 trillion in infrastructure projects. Here's the kicker. Nearly 70% of those loans were denominated in yuan, not dollars. Think about what that means. Countries are borrowing in Chinese currency, which means they need yuan to repay. That creates structural demand for China's currency instead of ours. Bilateral payment agreements have exploded. In 2015, fewer than 30 countries had yuan swap lines with China. Today, over 40 central banks have direct currency swap arrangements worth over $500 billion. Russia and China now settle 90% of their bilateral trade in rubles and yuan, $0 involved. Saudi Arabia, the country that literally created the petrodollar system in 1974, signed agreements in 2023 to accept yuan for oil sales. Let that sink in. The foundation of dollar dominance, oil transactions, is becoming optional. Then there's CIPS, China's cross-border interbank payment system. Think of it as China's answer to SWIFT, the global messaging network that moves trillions through Western banks every day. CIPS launched in 2015 with 23 participating banks. By 2024, it connected over 1,300 financial institutions in more than 100 countries. Transaction volume, over 80 trillion yuan annually, roughly 12 trillion US dollars flowing completely outside the Western banking system. This didn't happen overnight. It's the result of a 20-year financial strategy. While the US focused on military dominance and technological innovation, China focused on something more fundamental: plumbing. Financial plumbing. The pipes that move money around the world. Most people don't think about plumbing until it breaks. But in global finance, whoever builds the pipes controls the flow. And China has been laying pipe for 2 decades, while America assumed the old system would last forever. Now let's flip the script on fear. China doesn't need to crash the dollar. That's not the play here. Crashing the dollar would hurt China's own economy, destabilize global markets, and create chaos that benefits no one. They just need to make it optional. That's the genius of the strategy. When countries have viable alternatives to the dollar for trade, borrowing, and reserves, the dollar doesn't collapse. It just becomes less necessary. And necessity is what gives currency its power. Think about what this means for you. When the dollar loses necessity, it loses global demand. Lower demand means lower value relative to other currencies. Lower value means imports cost more. And America imports nearly everything, from electronics to clothing to critical components in our supply chains. Every iPhone component, every pair of sneakers, every pharmaceutical ingredient that comes from overseas suddenly costs more dollars to purchase. So Americans pay through higher prices, weaker savings, and silent inflation. It's not a dramatic crash. It's a slow squeeze that compounds month after month, year after year. And by the time most people notice, it's already priced into their lives. The groceries cost more, the vacation abroad is suddenly less affordable, the purchasing power just isn't what it used to be. This is controlled erosion, not catastrophic failure. And in many ways, that makes it more dangerous, because catastrophes trigger responses. Slow erosion triggers adjustment. People adapt, normalize, and accept the new reality without ever demanding change. Jeff Bezos once said, "Slow decisions destroy empires faster than bad ones." Let that sink in. In business, in geopolitics, in financial systems, hesitation kills. Not because slow decisions are wrong, but because while you're deliberating, someone else is moving. China is moving fast in banking. They're signing agreements, building infrastructure, and integrating financial systems across Asia, Africa, and Latin America. Meanwhile, the US is still debating yesterday's rules. We're arguing about regulations designed for the 1990s, while China builds the financial architecture of the 2030s. In finance, speed isn't aggression. It's survival. The first mover in infrastructure gains network effects. Every country that joins China's payment system makes it more valuable for the next country. Every bilateral currency agreement creates precedent for the next one. Every Chinese bank branch in Africa or Southeast Asia becomes a node in an alternative financial network. And once that network reaches critical mass, it doesn't need to be better than the dollar system. It just needs to be good enough and available. Let me give you a concrete example. Kenya, 2021. The country needed to build a high-speed railway connecting Nairobi to Mombasa, their largest port. Total project cost, $3.8 billion. They approached the World Bank first, following the traditional playbook. The World Bank offered financing, but with conditions. Structural adjustments to their economy, market liberalization requirements, environmental impact studies that would delay the project by years. And of course, the loans would be in US dollars, exposing Kenya to exchange rate risk. Then China made an offer. The Export-Import Bank of China provided 90% of the financing, $3.2 billion. But here's what made it different. The loan was denominated in yuan. Chinese contractors would build it using Chinese technology and materials. Repayment terms were longer, 20 years instead of 10. And there were no political conditions attached. No demands for democratic reforms. No requirements to open markets to American companies. Just infrastructure for debt. Kenya took the deal. Construction started within months. The railway opened in 2017, ahead of schedule. And when Kenya needed to make payments, they didn't need to acquire dollars on the foreign exchange market. They paid in yuan, or through agreements that allowed them to settle in local currency, swapped directly with Chinese banks. When a financial crisis hit in 2022, Kenya faced a dollar shortage. Their currency weakened, making dollar-denominated debt incredibly expensive to service. But the Chinese loans? Those were manageable because they had yuan swap lines and trade agreements that provided liquidity without touching the dollar system. That's when power quietly changed hands. Not through invasion, not through regime change, but through optionality. When you have choices, the old monopoly loses leverage. And leverage is everything in global finance. This isn't just Kenya. It's Pakistan, it's Ecuador, it's Angola, it's dozens of countries that now have financial relationships with China that operate completely parallel to the Western system. Here's the big reveal, and this is what keeps strategists awake at night. China's banking strategy isn't designed to defeat the US. Think bigger than that. It's designed to make the US irrelevant to global finance. Defeating implies confrontation, a winner and a loser, a clear battle with a decisive outcome. But irrelevance is different. Irrelevance means the game continues without you. Decisions get made without your input. Systems evolve without your participation. And the most aggressive phase of this shift is unfolding right now, within the next 12 months. Why now? Because multiple factors are converging simultaneously. First, the US dollar's strength over the past few years has created pain for dollar-denominated debt holders worldwide. When the dollar strengthens, it takes more local currency to buy dollars to service debt. Countries are actively looking for alternatives because maintaining dollar reserves has become expensive. Second, geopolitical tensions have accelerated the search for sanction-proof financial systems. When countries see the US weaponize the dollar through sanctions and asset freezes, they realize that dependence on American finance is a vulnerability, not a convenience. Russia got cut off from SWIFT in 2022. Overnight, hundreds of billions in reserves became inaccessible. That sent a message to every country watching. If political winds shift, your money isn't safe in the Western system. Third, digital currency infrastructure is maturing. China's digital yuan, the ECNY, is operational and expanding. This isn't cryptocurrency speculation. It's programmable money that can be deployed across borders instantly, with full state backing and none of the volatility that plagues Bitcoin or Ethereum. Over 260 million Chinese citizens have digital yuan wallets. Pilot programs are running with foreign central banks. This is infrastructure for a post-dollar world, and it's already functioning. Fourth, regional trade agreements are solidifying without US participation. RCEP, the Regional Comprehensive Economic Partnership, connects 15 Asia-Pacific countries representing 30% of global GDP and nearly half the world's population. It's designed to facilitate trade in local currencies, reducing dollar dependency across the world's most dynamic economic region. The US isn't part of it. We're watching from the outside while the rules get written without us. So here's the question that should terrify every American. If countries can trade, borrow, and settle debts without the dollar, what happens to American influence? Financial power has always been the foundation of geopolitical power. Military strength requires funding. Diplomatic leverage requires economic tools. Cultural influence follows economic ties. When America could control access to dollars, it controlled access to the global economy. That control is eroding, not through American weakness, but through the creation of alternatives. This isn't a conspiracy. It's not happening in secret. Every agreement, every infrastructure project, every bilateral currency swap is public information. But the cumulative effect isn't widely understood because we tend to see individual events, not systemic patterns. And patterns are everything in finance. A single country signing a yuan trade agreement is a curiosity. 50 countries doing it over 10 years is a structural shift. One Chinese bank opening in Africa is unremarkable. Hundreds of them processing billions in non-dollar transactions is a parallel financial universe. The question isn't whether this shift is happening. The evidence is overwhelming. The question is whether American policymakers recognize it fast enough to respond effectively, or whether we'll spend another decade debating yesterday's priorities while tomorrow's financial architecture gets built without us. In the next video, I'll break down how this banking shift could hit the American consumer faster than anyone expects. We're talking about real impacts on everyday life, mortgage rates, import costs, job markets, and retirement savings. Because when global finance shifts, Main Street feels it long before Wall Street admits it. If this changed how you see money and power, hit like. And tell me below, does the US see this coming, or are we already reacting too late? The most dangerous threats aren't the ones that announce themselves. They're the ones that arrive so gradually we mistake them for the new normal. And by then, adaptation isn't optional anymore. It's already happened.